What if I told you there's an ETF that follows Warren Buffett's stock picks and it pays you dividends every single month? Well, that ETF is OMA, a brand new fund which is targeting an annual yield of 15% with dividends distributed every single month. But can this ETF actually deliver, or is it too good to be true? Let's check it out. So the ETF OMA, which stands for the Vista Shares Berkshire Select Income ETF, it is designed to give investors exposure to Warren Buffett's top holdings, but with a twist. This ETF offers investors a core equity portfolio that generally mirrors the top 20 largest holdings of Berkshire Hathaway, as well as providing exposure directly to Berkshire Hathaway. Now, if we also take a look at this ETF's objectives, we can begin to see on how they actually plan to generate income. This fund will have two main components: investing in a portfolio of equity securities based on the solo active Vista Shares Select Index, and generating income through an options portfolio, primarily through the fund's option strategies, which seeks to achieve an annual income target of 15% distributed on a monthly basis. Now, you might also be wondering, how do options generate income? In simple terms, the fund writes covered call options, which means it collects payments, usually called premiums, from other investors in exchange for agreeing to sell its stocks at a fixed price in the future. This is what creates that regular income. Now, the trade-off is that if those stocks go up a lot, the fund might have to sell them at a lower price, which can limit the upside in exchange for that income. But sideways or mildly bullish markets, this strategy can be effective. Now remember, OMA will have a 15% target income yield, but what does that actually mean? The wording here can be a bit tricky. That 15% is an annualized target, but that doesn't mean investors will always see 15% total return. What they're referring to is the amount paid out in distributions, not accounting for things like the ETF's expense ratio, taxes, or changes in the share price. So your actual return could end up being higher or lower depending on those factors, especially if the fund's net asset value declines over time. The fund could end up returning more or less than that 15% target after these fees and expenses, but we won't know until it's on the market a little bit longer. Now let's start diving into the fund a little bit more, starting off with the dividends. OMA has been paying on a monthly basis, and right now the distribution rate is listed as that 15%, but remember, this is a forward-looking estimate, meaning that there's not much history to back it up just yet. The most recent distribution was about 1.25% of the share price, and if we look at the three payments so far, they're relatively consistent, ranging from 23 to 25 cents per share. So far, this ETF is showing potential. For dividend investors, it could be one to keep an eye on, and it might even shape up to be some real competition for funds like JEPI or JEPQ. Now let's take a look at the holdings for this fund. Their top holdings are Apple, Berkshire Hathaway, American Express, Coca-Cola, and Bank of America. In total, there are about 70 holdings. So now let's look at their sector exposure. As of April 30th, 2025, OMA's top sectors are currently 51% in financials, 14% in consumer staples, and energy and technology both at 7%. Next, let's take a look at OMA's share price over the last few months. Since they were first brought onto the market in March 2025, they have dropped as low as $17 per share, but also hit highs as much as $20 per share. They currently trade around $19, but remember, this is an income fund, so it's not intended to also be growing the share price. So now that you've seen the yield, the holdings, and the price performance, what does this all mean for you as an investor? Well, it depends on what you're looking for. OMA is clearly built for income-first investors. The 15% target yield is attractive, but it's important to remember that high yield often comes with trade-offs, especially when it comes to capital preservation. Since this ETF uses a option strategy, you're giving up some upside in exchange for consistent cash flow. If you're someone who relies on monthly income, like retirees or income-focused investors, this could be an option, especially in a sideways or uncertain market. But this fund is still in the early days. With only a few months of history, we just don't know how this ETF will perform through a full market cycle, particularly in downturns or strong bull markets where the covered call strategy might underperform. Risk management, NAV erosion, and the long-term sustainability of the distributions will be key things to watch moving forward. Now, how does OMA stack up against more established income funds like JEPI and JEPQ? Well, JEPI also uses covered calls and has a track record of balancing income with some growth. JEPQ leans more tech heavy and can be a bit more volatile. OMA's edge is that it mirrors Warren Buffett's stock picks, a basket of large, stable companies, giving it a more defensive core, but with that added twist of options income. I'll be watching OMA closely over the next few quarters to see if it lives up to the hype, but if you found this breakdown helpful, make sure to leave a like and subscribe for more ETF content. And let me know in the comments below, would you invest in a fund like this?